Hi there, Dan Ferris here, editor of Extreme Value, which is a value investing newsletter published by Stansberry Research. You can find more about it at stansberryresearch.com, or you can go straight to extremevalueoffer.com if you're interested in subscribing. Today's video is inspired by some stuff that I saw on Twitter about earnings growth, and I think it's kind of an important topic for us to cover real quickly today. So that's what we'll talk about. It's just about how well you can expect the stock market to perform, the S&P 500 at any rate, when earnings are growing by a certain amount. And there was some good data by Ned Davis Research that I saw that I wanted to tell you about. So let's do that. Okay, so we all know, or perhaps we've all heard, and it makes some amount of sense, that earnings drive the market. Earnings drive the performance of the S&P 500. And that makes a lot of sense. One would think, other things being equal, if a business's earnings rise by 10%, then its value has gone up by 10%. It turns out that it's not quite like that. Certainly you can say that the value has gone up by 10%, but you can't necessarily say that the publicly quoted, the exchange quoted share price can be counted on to respond in that one-to-one fashion, that earnings growth of 10% will result in a share price increase of 10%. No. No, in fact, what I saw from actually Charles Schwab and Ned Davis Research both published it, and there were some comments by Liz Ann Saunders from Charles Schwab in a CNBC article, okay? And I was fascinated by the Ned Davis Research, which showed that at the highest level, at the fastest rate of earnings growth, 20% and above, the stock market did poorly, most poorly, except with one exception. When earnings were shrinking 25% a year over year or more, that's when the stock market did worst, obviously. But when earnings are growing at more than 20% a year, that other than that time when you get that big shrinkage, that's when the S&P 500 has performed the worst, right? So when the S&P 500 when earnings are growing more than 20% a year, you can expect about 2.6% a year annualized out of the S&P 500 for your return. Whoa, that blew me away. And I want to get the numbers right, so I got it on my screen here. So here's what Ned Davis Research found. They went back to 1927, so from March 1927 to March 2018. And earnings growth of greater than 20% is usually accompanied by S&P 500 annualized gains of 2.6%. Earnings growth of 10 to 20% is usually accompanied by annualized S&P 500 gain is 7.4%. Earnings growth of negative 10 to 10% is S&P 500 of 9.2% a year. Amazing, huh? And the best performance you can expect is when earnings are shrinking. Negative 25 to negative 10% a year has resulted historically during that time period I just said by annualized S&P 500 gains of 25% a year. Whoa! I mean, intuitively, you would never guess this, right? But if you think about it, well, of course it kind of turns out that way, right? Because it's not just that earnings have gone up by a certain amount. It's earnings have gone up by a certain amount after, stocks have performed in a certain way. So when you see earnings growing more than 20%, well, that's generally late in the cycle. And, the S&P 500 is a triple since 2009. So it doesn't, it's not going to go up another 25% just because earnings have gone up 25%. We've been discounting 25% earnings growth for some time here. So, and when you get, for example, when the S&P 500 earnings have shrunk 25 to 10% a year, well, that's probably, the market's probably been down prior to that. So, people are anticipating a recovery at those levels. And indeed, it's been very rare that S&P 500 500 earnings have shrunk by more than 25%. So that makes a lot of sense. People see that negative 25% earnings growth in the S&P 500. They say, well, this is the bottom. And mostly they're right. Okay? So that's when you get your big gains, those big V kind of shape recoveries. So yeah, earnings drive the market, but that isn't enough information to really tell you anything meaningful. And what I glean from this is, I'm going to go out on a limb here because the data that I'm quoting you doesn't say this, but I'm going to guess that valuation matters is the other part of this equation, and that when you see earnings growth more than 20% a year, and right now, I'm sorry, year over year, so far 70, actually almost all the S&P 500 companies have reported quarterly earnings, and I know 78% of them beat Wall Street estimates, which is like the highest number since anybody's been tracking this stuff since, like, I think FactSet Research has been tracking since 2008. So really, kind of off the charts earnings growth here, almost 25%. And when that happens late in a cycle, it's not just the earnings growth, it's happening late in the cycle when stocks are pushing up against all-time high valuations. Certainly by price to sales, which I know historically correlates much better with subsequent 10-year returns than price to earnings. Price to sales and other similar measures that are tracked by John Hussman at HussmanFunds.com are really the best and most highly correlated with subsequent 10-year earnings growth on the S&P 500. And the all-time record for that was just set in January for S&P 500 price to sales. We said that in a previous video. So, all-time high price to sales is going to be all-time crappiest subsequent 10-year S&P 500 returns, right? Value is what you get, and price is what you pay. Value is what you get, and when you pay too much, the value is less and less and less, right? The price is more and more, the value is less and less and less. And at some point, even paying an exorbitant price for the very best business in the world is a disastrous idea. It's a disastrous action, and history has proven that. Companies, if you're buying Amazon.com today, and you're buying, Amazon, Microsoft, Facebook, Netflix, Google, Alphabet. I still call Alphabet Google. That won't save you. Buying the highest quality businesses, and they are wonderful businesses, don't get me wrong, it won't save you because you're paying exorbitant prices for everything, for just about everything you're buying in U.S. stocks today. So you have to be, you can't be too shallow about this. You have to go in another level, and you have to think, how much am I paying? In the case of Amazon, I haven't updated it recently, but I think we're at around 65 or 70 times all the pre-tax income Amazon has ever earned since it was founded. Wow. So that's a lot to pay for a business. It doesn't even matter, even if it's Amazon, it's a lot to pay. And people have thought as highly of other businesses in the past as they do about Amazon today. And we did a video. You can look back on the channel here and look for the Cisco video about Cisco Systems, and that's the same idea. People thought that was the no-brainer, most wonderful business of the day. It was owned by 10 of the top mutual funds of the day, and it did horribly. It still hasn't recovered. I think it's barely made it 50% of its March 2000 high. So you can buy a wonderful business at an exorbitantly high price and do very poorly. And I think that's what's happening right now with a lot of these companies. And the data that we saw from Ned Davis that was published on CNBC and other places on Twitter today kind of demonstrates that, I think. It demonstrates that late in the cycle, earnings are growing as fast as they ever have, at their highest ever rates. It's almost like the world is saying, that movie by Jack Nicholson, This is as good as it gets. Did you ever think, Nicholson says, you ever think maybe this is as good as it gets? Because that's where we are. You have to start thinking maybe this is as good as it gets. And you have to be careful. You can't overpay for equities. So I just want to put that idea in your head. You know, when you're poorly compensated for taking risk, you're going to do very poorly. And the Hussman data shows that. This Ned Davis research data strongly suggests it in a roundabout way. And, you know, common sense tells you, you know, the more you pay, the less you make. Um, and I saw another thing on Twitter that said that demonstrated that same thing. European junk bond yields were down around 2% some months ago. And I saw a chart from Bloomberg that was published on Twitter today of just the past 3 or 4 days of trading, and with the European junk yields just going straight ballistic, which means the prices were just plummeting, you know, over a 3-day period. And that's what happens. And I haven't really, I've tried, but I haven't really found the best way to show people how quickly, oh boy, sorry, how quickly things can go badly when you're very poorly compensated for risk, when the valuations get to extreme high levels like that. And you know, the example of March 2000 is the one of the best ones. Of course, October, you know, September, October 1929 isn't bad. Um, there aren't enough of those examples, in fact, and to get more of them, you kind of have to look at specific sectors and different countries and, you know, different asset classes. But you do notice over time that once the valuations get really exorbitant, it's only a matter of time before it all falls apart, and you know, you're seeing the asset prices really collapse. And I think that'll happen with U.S. stocks. It's bound to happen at some point. I don't think earnings aren't going to catch up to the valuation. That never happens. They're just going to, you know, you're going to see the asset prices, the stock prices collapse back in line with earnings, and then below, you know, you don't mean revert straight to the mean. You generally overshoot on the downside. So it's you know, I continue to counsel caution in buying U.S. stocks. I don't care how well the U.S. market performs. The better it performs, the more expensive they get. So be careful. Only buy stocks when you get a sufficient margin of safety. We found 3 really good deals so far this year. Actually, we just found a 4th. We found a nice event-driven kind of situation. A big cap company trading at a 30% discount to peers, which I think could even result in triple-digit returns once it's broken up into several pieces. Should be really interesting. So, you know, that kind of stuff you can do right now, but, you know, in general, counting on earnings growth to kind of bail you out is the worst that idea has been for at least going back to 2010, as we said earlier. Um, so be careful. Only buy stocks when you have a margin of safety that is really substantial, and hold lots of cash. Don't be afraid to hold lots of cash. Okay? And I'll talk to you next time. Bye.